Good afternoon. It is Friday, February 2nd. Groundhog Day. 3:38 p.m. Markets have about 20 minutes to close. It's a sea of red out there, people. And I think it's very appropriate that it happened on Groundhog Day, okay? Because everybody always seems to repeat the same mistakes over and over and over. I'm talking about the movie Groundhog Day, okay? Not the groundhogs that have come out of hibernation today to, see if there's going to be an early spring. But that's appropriate too, because, they have one in Pennsylvania, and he came out, Phil, I think his name is, and he saw his shadow, so he's predicting more of a winter. And then there's one on Staten Island. I don't know what his name is. I think he didn't see his shadow. So he's calling for an early spring, all right? And their predictions are just as good as what you get on CNBC. I'll be honest, okay? At least they're on the level, okay? So let's give these groundhogs a little, a little cheer, all right? It's very interesting, this midwinter celebration, Spring is right around the corner. But I think as far as these markets go, we're in for for a long winter. I don't think today's the day to get too technical. I think it's the day to just reflect. I got up bright and early today. I was waiting for this non-farm payroll report to come out. I said yesterday, let's see if they use this as an excuse to whack gold. Maybe they would, maybe they wouldn't. And they did, okay? And this is just another, this is Groundhog Day all over again, right? So today, gold was doing fairly well. It was up 1348. Then it started to come down. And then boom, that usual time, they whacked it straight down. That was at 8:30, right when the number came out. They whacked it down. And then at 8:35, it continued to sell off. Straight down on this non-farm payroll news. Then at 9 o'clock, 9:03, continued to bleed off, down 1370. And it continued the rest of the day to bleed off. I want to get back into that. There's a lot to cover. Yesterday, I believe it was, I mentioned Greenspan had given an interview. And I went back and I listened to the interview. I think it's very interesting. He gave an interview with Tom Keene and Scarlett Fu of Bloomberg. Okay? Tom Keene. One of the things we've been talking about is our expanding debt and our expanding deficit. It gives pause that it will go to $1 trillion in deficit year in the near future. What do those debts and deficits mean to Alan Greenspan? Talking about the debt, the deficits. Alan Greenspan's response. They mean what it is meaning to everybody else, namely that we are dealing with a fiscally unstable long-term outlook. Fiscally unstable long-term outlook. Now, this is the maestro speaking. He's an old man now, okay? But they used to bow down to him, right? So now he's gotten religion, okay? Namely that we are dealing with a fiscally unstable long-term outlook in which inflation will take hold. Okay? And all you heard this morning on CNBC, inflation, 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 right? And I had said, they're going to get it in spades, right? The inflation genie is out of the bottle. Okay? And we have to get into that too. In fact, I was very much surprised that in the State of the Union message yesterday, all those new initiatives, infrastructure, at least 1.5 trillion, right? All those new initiatives were not funded, right? Who needs to fund it? Let's just print the money. Who cares about the debt? Okay, we'll build all the bridges and the roads and the airports, right? And it'll pay for itself in the end somehow, right? Let the next guy worry about it. And I think we're getting to the point now where the breakout is going to be on the inflation upside. The only question is when. I think it's here. I think we got the answer. I think it's breaking out. Okay? When we've been through it almost a decade now of stagnation, right? A decade of stagnation. And we're working our way towards stagflation. So now we're going to get inflation, right? And stagnation as well, right? Which, as you know, is a combination of both of those, right? That's that misery index back in the 70s. Nobody's working. Nobody's really making any money, all right? And at the same time, you have inflation, right? The misery index of the 70s. It's back. It's back. It's going to be back. It is a very difficult type of monetary policy to be in. But I think what we're seeing eventually here is an issue where we've got to confront the deficit. Eventually, we're going to have to confront this. But these politicians don't want to. Because they got to make hard choices. In fact, I've been arguing for quite a long time, a period of time, that entitlements are eating into gross domestic savings, and they've been doing that consistently dollar for dollar since 1965. You knock down gross domestic savings, and inevitably domestic debt, basically every type of debt, tends to rise, and we've got to get out of this loop. This is the maestro speaking. So now, Scarlet Fu. We are in a bit of a vicious cycle here, Chairman Greenspan. You mentioned a fiscally unstable long-term outlook in which inflation will take hold. We are looking at a weaker dollar. It's been weakening for a while now, and the administration has talked up the benefits of a further weakening dollar helping our exports. To what extent will that contribute to inflation? At what point does that start to carry over and we see that subsequent price rise? Sooner rather than later was his very just point of fact answer. Sooner rather than later. And they were like, well, very well said, Scarlet Fu continues. Sooner rather than later. Is there a risk of a weaker U.S. dollar that we are not seeing just yet? I mean, as we wait for inflation, we're waiting for inflation. It's like we're all waiting. We know it's coming, and we're waiting for this inflation. What are the risks that it is creating in the financial system right now? Look, just remember, with the size of the international system, the value of the dollar vis-a-vis all other currencies is a critical issue in the domestic price outlook in the United States. And I suspect if we get a continued drop in the dollar, which has now been going on for a while, that's going to have some additional effect on the price level, the domestic price level, and that's beginning to rise for a lot of reasons you just recently mentioned. Namely, that productivity has been dead in the water for the last 10 years almost. Productivity growth has been 1.5% per year when it used to be over 2%. That's a huge difference. He's not pulling any punches. He doesn't have to anymore. Okay? He's the cause of all of this to begin with. He started it all. Okay? So now I guess he wants to try to clear up his name. That means unit labor costs are now going to start to move up, and with profit margins rising, that tells you where the price levels are going to be. Tom Keene. Chairman Greenspan, I know you don't want to speak about present and even future Fed chairman. I don't want you to pontificate on what Jerome Powell's to-do list is. Jerome Powell is about to walk into an absolute disaster, okay? Janet Yellen, she had her victory lap. She can go out and give speeches now with Ben Bernanke. They saved the economy, okay? And now Jerome Powell is going to be forced to clean up this mess, okay? And we can get into that too. You know, I remember, it's like the old musical chairs. When the music stops, you know, well, it's stopping now, and Jerome Powell, you know, he don't have a chair. You don't have to pontificate on what Jerome Powell's to-do list is, but can you talk about the underlying theories of the PhDs, these eggheads who think they can run an economy, okay, from a junior year textbook, okay? These academic eggheads, these PhDs, okay, who've created the biggest, ugliest, fattest bubble in the history of the world. Am I clear enough? But can you talk about the underlying theories of the PhDs at the Eccles building? Then he hits him with this question, this Tom Keene, who likes to cut off all the people he's interviewing. He always likes to cut them off. He doesn't listen to what they say because he wants to get the next question in. And he doesn't care what the answer is. Okay? So he comes out and asks him, does Alan Greenspan still believe in the Phillips curve? There it is. Alan Greenspan's answer, I never did. And laughter ensues. Okay? I never did. This discredited Phillips curve model. Right? This wage growth. Right? When we get wage growth, that's inflation. No. Alan Greenspan. Well, within that, and with the Tom Keene. Well, within that, because now he's startled to think Alan Greenspan never believed in the Phillips curve. Well, within that, and with the sainthood of the Phillips curve right now, or at least it being as honored as it is, which model should we use when we move into the rest of this decade? Which model? Well, let me just say this. There was a big dispute in the 1990s about the Phillips curve. The Phillips curve was supposed to basically engender inflation as the unemployment rate fell. Right? As more and more people are employed, right? You start to get a tighter labor market. Salaries are supposed to increase. And that brings on inflation. In theory, in their junior year textbooks. Well, the unemployment rate kept falling, but productivity was accelerating at the time, so unit labor costs didn't move. And we had a period where the Phillips curve just did not work. The Phillips curve presupposes a certain fixed rate in productivity growth, and that is not the way the world works. So now, Scarlet Fu. This is an interesting article. I know there's a lot of drama going on right now on CNBC, but at the end of the day, they're just an entertainment show. Okay? That's how I look at it, right? Entertainment. Shills and cheerleaders, okay? Just entertaining. Scarlet Fu. Yeah, we're missing that right now, meaning this productivity, right? And this Phillips curve. Speaking of the 1990s, Alan, you famously used the term irrational exuberance to describe the bullish sentiment that was driving up stock prices during the dot-com bubble. I believe you used the term in 1996 in a speech. She hits him with this question. Do you see any signs of irrational exuberance in asset prices today? Good question. Alan Greenspan's response. Well, let me put it to you this way. I think there are two bubbles. I would agree. Actually, I would probably throw in three, if you include real estate. I think there are two bubbles. We have a stock market bubble, and we have a bond market bubble. And I think in the end of the day, the bond market bubble will eventually be the critical issue. Because this is the debt bubble, and all the other bubbles are based on this. But for the short term, it's not too bad. But we're working, obviously, towards a major increase in long-term interest rates. We're obviously working towards a major increase in long-term interest rates. And that has a very important impact, as you know, on the whole structure of the economy. Scarlet Fu. So he just said, he came out point blank. We have a stock market bubble. We have a bond market bubble. Long-term interest rates are going up dramatically. And that's going to change everything. So, Scarlet Fu, so we're in a bond market bubble. You don't believe in the proclamations that a bear market has begun in bonds, so this move towards 3%, we're not there, obviously. If we do get there, it can't sustain itself. What's behind that? This 3% now. That's the thing. And Alan Greenspan, you mean what's behind the bubble? Well, the fact that essentially we're beginning to run an ever larger government deficit. Remember that we're talking now about deficits growing to $1 trillion, but debt has been rising very significantly, and we are, in fact, if you wanted to take the Congressional Budget Office's figures at face value, we're going to run through the peaks of where we were during World War II on the ratio of federal debt to GDP. Debt to GDP, it's going back to where we were in World War II. Okay, which is extraordinarily high, and I think we are just not paying enough attention to that, right? Everybody's whistling past graveyards, right? The maestro is coming out. He's unequivocally saying we got two bubbles, right? Major increase in long-term interest rates. This is going to turn everything upside down, and the debt to GDP ratio is going all the way back to World War II. Then Tom Keene, he wanted to turn it into a political discussion, so I ended it there. Okay? Very, very, very telling interview. Former Fed Chair Alan Greenspan sees bubbles in stocks and bonds. The man who made the term irrational exuberance famous says investors are at it again. They're at it again. We repeat the same mistakes over and over and over again. It's Groundhog Day. There are two bubbles. We have a stock market bubble and we have a bond market bubble. I'm not going to read it. It's basically what I just said. Greenspan sounded an alarm on forecasts that the U.S. government deficit will continue to climb as a share of gross domestic product. He said he was surprised that President Donald Trump didn't specify how he would fund the new government, so on and so forth. On Wednesday, the Fed opted to leave rates unchanged. So what happened today? We got a non-farm payroll, right? 200,000 jobs were created. We got a wage growth increase, 2.9%, right? And stocks started to sell off, okay? Because supposedly good news is bad news. Just proving that this whole stock market bubble has been based on only one thing: cheap money. Okay? Feed me, feed me, feed me. Right? Like that Little Shop of Horrors I said a month or two back, right? Ever increasing debt to feed me. So good news is bad news. I want to look at this. I went to the Bureau of Labor Statistics. Okay? Household survey data. In January, the unemployment rate was 4.1% for the fourth consecutive month. The unemployment rate is holding steady at this 4.1%. Okay? And remember these Fed heads. Well, we can't overshoot to the downside, right? We don't want it to overheat too much. The number of unemployed persons at 6.7 million changed little over the month. So the number of unemployed changed little, okay? Among the major worker groups, the unemployment rate for blacks increased to 7.7% in January, and the rate for whites edged down to 3.5%. The jobless rates for adult men, 3.9%, adult women, 3.6%, teenagers, 13.9%, Asians, 3.0%, and Hispanics, 5.0%, showed little change. Little change again, little change. The number of long-term unemployed those jobless for 27 weeks or more, they're out of work for half the year, was little changed. There's a lot of little changes in this report. But yet the market didn't think this was a little change. If they're basing it on this report. The number of long-term unemployed, those jobless for 27 weeks or more, was little changed at 1.4 million in January and accounted for 21.5% of the unemployed. 1/5 of the unemployed have been out of work for 6 months. They're not turning around and getting a job in a week or two. The civilian labor force and total employment, as measured by the household survey, changed little in January. Little. After accounting for the annual adjustments to the population controls. The labor force participation rate was 62.7% for the 4th consecutive month. No change there. And the employment population ratio was 60.1% in the 3rd month in a row. No change there. The number of persons employed part-time for economic reasons, sometimes referred to as the involuntary part-time worker. I want to work full-time, but there's no job, so I got to work part-time, right? I got to be the Uber driver in the day. I got to be the bartender at night, okay? On the weekends, I got to have my side hustle, right? This is what it is, people. Everybody's side hustling. Remember that? The number of persons employed part-time for economic reasons, sometimes referred to as the involuntary part-time workers, was essentially unchanged. There it is again. This report, okay? It was last year. It was last month's report. What's the big difference here? Everything is little change, unchanged. Was essentially unchanged at 5 million in January. These individuals who would have preferred full-time employment were working part-time because their hours had been cut back or because they were unable to find a full-time job. In January, 1.7 million persons were marginally attached to the labor force. Little change from a year earlier. It goes on and on and on and on. No change. Now, there's a long article. I'm going to skip it. This is the unemployment rate seasonally adjusted. You could see that that's it. It's flatlining at 4.1%. So this might be as good as it gets, people. This might be as good as it gets, okay? And this is the non-farm payroll report, 200,000. This is January 2016 to January 2018, all right? There's the number. It wasn't statistically, basically any better. I mean, it certainly wasn't the high. It's kind of like, a little high, but overall just basically another average report, okay? But it was this supposedly wage growth, all right? Now, there's one thing in here. Actually, I shouldn't skip this if I could find it real fast, because this is important. The average work week for all employees on private non-farm payrolls declined by 0.2 hours to 34.3 hours in January. Okay, so if there's a decline in the number of hours, right, there is an increase in the rate. Okay, so this might be the half is glass full, the glass is half empty type of thing, okay? So we got to see this. But anyway, that's not what I wanted to talk about, really. I mean, it is, but it's important. But obviously, these rates are skyrocketing. And I was watching CNBC pretty much all day today. And you could see the deer in the headlight look on these guys' faces. And all the excuses, all right? And all these I don't know what you call them, that they have to parade out, okay? And now you get all the talking points. You get things like the rates are going up for a good reason. The economy is growing, it's doing good. The rate, this is a good thing. with these, because they're going up for the right reason this time. So you're going to hear that, okay? You're going to hear, well, you know, we don't have to worry about rates until we get to 3%. And then it's going to stop there, like they know, you know. So I wish I had a tape recorder while I was watching it. I was highlighting some of the notes that people were saying, and it literally floored me. It really did. For example, one guy, he said, and I don't know their names really. Good for them that I don't, right? Because now here's another thing you're going to get. Here's another talking point, which one guy says, the smart money will come in early next week, with this smug, arrogant look on his face, okay? I wanted to reach through the TV screen, pull him into my living room, all right? The smart money will come in early next week, okay? This guy's one name I do know, because I happen to know him because I've seen him. This guy, Jim Oreo. He says, this is just a garden variety correction. Just a garden variety correction. Don't worry about this, okay? There's this other guy, I don't know what his name is. It's a good time to step in and buy stocks. It's always a good time to buy stocks with these people. Stock market is going up. Well, you can't miss out. You got to get in. Stock market is going down. Well, you know, you're getting a bargain. You got to get in. It's always a good time to buy stocks with these people. This one guy, again, I don't know his name. I thought his first name was David or something. This floored me. This really floored me. He doesn't see any scenario of how the Fed screws this up. Does that take the cake, people? He doesn't see any scenario how the Fed screws this up. I got to find out this guy's name in full, and I got to say this again on Monday. The Fed has already screwed this up. They never get it right. They've created this monster, and he doesn't have, there's no scenario how the Fed screws this up. Then Steve Leisman, okay? Now he's starting to say, well, you know, the rates are going up, right? This is kind of like normal. Shouldn't the rates be going up? Everything is so good. The question should be why, not why the rates are going up now, but why were they so low to begin with? Why were rates so low? The rates were so low, Steve Leisman, because the Fed manipulated the bond market with QE to keep the rates low, Steve Leisman. You know that. So who are you kidding, Steve Leisman? That's why the rates were low. We got $20 trillion in debt. Okay? If the interest rates rise, how on earth are we going to service this debt, Steve Leisman? Then he says, you know, and I got to show you a picture, because now they start talking about how the Fed, now they're going to be really aggressive and they're going to start raising rates. As if they can. As if they can't. Now this is it. The Fed is going to fight inflation. They wanted inflation all this time. Now that they got it, well, now they're going to slam on the brakes, right? They wanted wage growth all this time, right? They got a little sniff of it, supposedly at 2.9%. Now they're going to slam on the brakes. Does this make any sense to you? When are we going to get the free markets back? When are we going to take these people and swab the deck with them? Throw their carcasses overboard. So I'm watching CNBC, and, you know, a picture is worth 1,000 words. Fed rate hike probabilities, okay? There's a 90% probability of a March rate hike. There's a 61% probability of a June rate hike. And there's a 54% probability of a December rate hike this year. So I'm thinking this is cumulative, meaning one rate hike, 90% in March. Two rate hikes, you got a March rate hike and a June rate hike, 61% probability. And then you got three rate hikes in 1 year, right? March, June, and December, basically 50%, 54% probability you're going to get 3 rate hikes, okay? Because the Fed can fight inflation, okay? Then, and somebody asked this question a few nights ago, right? What's the probability of a 4th rate hike? Okay? 11% November, 20% December, and then 60% January of 19. All right? So they got this basically three rate hikes, maybe in a 4th rate hike. So now Steve Leisman, he asked the question, 4 rate hikes, that's kind of boring. Is it time to start mentioning 5? You see what they're doing, people? You see what they're doing? These shills. They want you to think that the Fed has everything under control and they could raise rates 5 times and take care of all this. No, not at all. They want you to think the smart money is going to come in and buy stocks. This is a garden variety correction, okay? It's always a good time to buy stocks. The Fed could take care of this. So much. So much. Rick Santelli said that his red flag is 3.03 on the 10-year. Okay, now at the velocity that we're going, right? And I showed you a chart at a 10-year a few weeks back. If you remember, where we looked at the 10-year, and there were these times when it just spiked, and then spiked, right? And this is another spike. So he's looking at 3.03%, right? Then we got to maybe start worrying. Then maybe stocks will react. Being down 600 points today on the Dow, they're not reacting yet, We got to wait till we get to 3, and then 3 is the ceiling. Nobody knows what the ceiling is going to be here. Okay, let's get that clear. Okay? So then this other guy comes on, Ralph Acapora, whatever, and he says his red line is 5%. Okay, that's when he'll start to worry, when it gets up to 5. Okay? So don't worry now. And that's a long way off. The way these rates are going, okay, we'll be at 3 in a blink of an eye. And there's no stopping it. All right? Now, I was watching gold. I want to close with one thing. Gold had a rough day today. Okay? And I'm not here to cheerlead gold. You know that. I haven't been one of these gold pumpers. I haven't been one of these golds going to 5,000. Okay? I haven't been a carnival barker. Okay? Gold's had a rough day today. But in the scheme of things, since this December rate hike, gold has been on a tear. And I said 1340 was going to be a battle. And a lot of people were like, no, we'll get right over that. We're going to 1400. I don't know. They knew something I didn't know. Okay? Now, the moving averages, okay, gold is still overbought. It's still stretched above its moving average. A correction here is not the end of the world, all right? It really isn't. We have to watch it. Again, I'm not cheerleading, okay? But I'm going to say this. In 2008, gold was the victim of its own success. And what I mean by that, okay, when you start getting margin calls, then you got to liquidate other positions, right? People were turning to gold. They were liquidating to cover their margin calls. So initially, gold took a hit, just like with stocks. But what happened after that? Gold soared, right? Went to all-time highs. So this turbulence today, it doesn't bother me really, okay? It was due for a correction, okay? It's above its moving averages. All right. But if this thing plays out like it could, with inflation, right, and the Fed is powerless to stop it, and rates start spiking, and stocks start collapsing, I don't think there's any better place I'd rather be than gold. So let's just stay focused. The VIX was up 30% today. I said, watch the VIX starting to make some noise. 30%. Maybe there's a little fear coming back into these markets. The dollar really was not up all that much. It really wasn't. Okay? And the 10-year spiking, and the 30-year. So this has been long, people, but I think it was important. Let's not get sidetracked. Anyway, beautiful day today. Sunny, gorgeous, little windy. If you can get out, get out. This weekend, use this weekend to just, get out, rest, focus, get perspective. And Lord willing, we pick it up on Monday. Ciao.